Assalamualaikum warahmatullahi wabarakatuh. I will present my report text as it may relate to financial statement analysis. My name Muhammad Hidayatullah, NPM C1C021148, kelas 1C. Financial statement analysis. Financial statement analysis is an important and integrated part of business analysis. Business analysis itself is the process of evaluating the prospect and economic risks of a business entity or company. The analysis carried out includes an analysis of the business environment, an analysis of the strategies implemented by the company, and analysis of the company's positioning, and an analysis of the company's financial performance. Business analysis is indispensable for the decision-making process for various business activities, including decision-making, investment, credit, company valuating, in the process of offering shares, EPO, initial public offering, corporate restoration, and decision-making by management in running the well company. Meanwhile, financial statement analysis (ALK) is a process or the activity of analyzing the company's financial statements by using analytical tools and techniques to obtain useful information recorded in business analysis, mainly to understand performance, financial achievement that the company has achieved in its three main activities: operational, investment, and financing activities. By analyzing financial statements, all parties who interested parties will get more accurate information or can rely on the decision making. They won't base it solely on subjective assumption and intuition alone. Therefore, the result of the analysis of financial statements are able to reduce the element of uncertainty that faced by decision makers. After studying this module, students are expected to be able to explain how to do an analysis of the company's financial performance, good for internal management needs and stock investment or capital market. In particular, students are expected to be able to explain 1. Financial statements used for the report analysis process finance. 2. Understanding of financial statement analysis. 3. Financial statement analysis function. 4. The purpose of financial statement analysis. 5. Steps of financial statements analysis. 6. The tools used in the analysis of financial statements. 7. Parties with an interest in financial statement analysis. Next, financial statement at the end of the financial reporting period, monthly, quarterly, semi-annually, or annually. Companies are required to prepare reports that inform all business activities it does, good activity, investment, and funding, as well as operational activities for each period certain. In the report, investment and financing activities are reported by company in the balance sheet and statement of change in the capital or statement of owner's equity. As for operational activities reported in the income statement, loss and income statement. To complete the three reports, the company also needs to make a flow statement cash. This report contains information describing operation, investment, and financing on a cash basis. Next, balance of a balance sheet is referred to as a company's statement of financial position. This is of course quite reasonable because the information on the balance sheet report the value of the company's assets, liabilities, and owner's equity on a specific debt position, generally made at the end of each year or as of 31 December. The balance sheet also provides information about the nature and amount investment made by the company, assets, a source of funding that come from creditors, liabilities, and source of funding that come from owner of the company or owner's equity. Assets, also known as company assets, are a source of the resource used by management to generate profits through in operating activity. Thus, assets can be said to be all property, well of a business entity that can be valued by money, both tangible and abstract or intangible, tangible or intangible. These assets on the balance sheet are palettes on the left side and classified into current assets, asset cash, securities, notes receivable, receivables, and inventories, fixed asset, land, buildings, and transportation equipment, and asset intangibles, goodwill, patents, and marks. On the right side of the balance sheet are called liabilities. The passive side is often said as a source of corporate funding. Therefore, the liabilities consist of two parts, namely liabilities or debts, and owner equity company. Liabilities is a source of funding obtained companies from second parties, creditors, suppliers, shares responsibilities or current liabilities, trade payables, bank loans, unearned rent, and long-term debt, mortgages, and bonds. Will the holders, equity shares owners of the company, reflect funding that come from owner of the company and the amount of profit that is not shared, not taken to the owners. From the owner's perspective, this equity reflects what is the value of the asset to which they are entitled. Next, statement of change in capital. This report shows change in the capital of company in a certain period. For company with the form of a company, this report referred to as a change in shareholders' equity. This report used for identifying the cause of change in owners' equity, the company, over the value of the assets to which it is entitled, or net assets. Next, income statements. The income statement is a report that presents the operating activities by the company for a certain period. This report presents information about revenues, expenses, gains, and loss experienced by company for a certain period. Financial statement use income statement information to evaluate performance has been achieved by the company and provides an overview of the achievement of current cash in the future. The profit generated reflects the level of profitability achieved by the company, which is usually used as an indicator of the level or profitability among others. 1. Gross margin or profit margin, gross margin. 2. Operating profit. 3. Profit before tax. 4. Profit from continuing operation. One thing that must be underlined is the profit is calculated with using the accrual basis. Under this accrual basis, revenue is recognized when the company delivers goods or service, regardless of whether the cash has been achieved